Beautiful. So thank you so much, everyone, for coming. Really, before I get started, I would just like, I've got sort of a bit of a narrow field, but would like to get a sense of just kind of in terms of the audience, just put up your hand. How many people currently have investments in the market, mutual funds, ETFs? How many people have stocks or bonds? Okay, most of you, perfect. How many people have responsible investments? Socially responsible, sustainable, green stuff? A couple. Okay, so that's fine. And this is good because what this tells me is that you're probably going to be learning something tonight. Um, so I'm going to be talking tonight about the power of sustainable investing. I do want to start with a couple of acknowledgements. Really just to say that investing does come with some degree of privilege. That for us to even be talking about investing, if you put up your hand, what that means is that chances are you're earning more than you're spending, right? You're not living paycheck to paycheck. We've got enough money to be able to set aside for the future, which is very important, but does put us in a bit of a privileged situation. I always love reminding people that the household median income in Canada is only $57,000, meaning that half of households, and often this is like two people earning that, less than 57K. And that a third of Canadians don't have an RSP or a TFSA. So, if we are, I'm someone where I do have an RSP and a TFSA. That kind of puts me, it shows that, I am in a bit of a privileged situation to be able to have this conversation. The last thing I want to acknowledge is that sustainable investing is not a silver bullet. All too often I get, there are these little debates that happen where, people say, oh, well, we need to eat less meat, or we need to ride our bike, or get an electric car, or, people have their sort of preferred technology, and that's all fine. I'm not arguing against any of that. I'm saying very much yes, and, do all of those things to reduce your carbon footprint. And this is another sort of tool in your tool belt to help you be able to reduce your carbon footprint and be able to sort of live a more ethical life. But I want to be clear, this is not a silver bullet. I'm not saying that everybody needs to do this. It's just more that really this is going to be a great approach if you want to be able to take a step further in terms of your actions. Now, I'm going to have a lot of pie charts for you tonight, right? Investing, we have lots of pie charts. I figured I would start with a cake chart. This is a really nice diagram that sort of illustrates my view of the world in terms of the economy. Now, this is an image from Hazel Henderson, who's a mentor of mine. Does anyone recognize the name Hazel Henderson? I'm just curious. There's anyone? A couple small hands I see there. Awesome. So she's a mentor of mine, and we collaborate on a project called the Green Transition Scoreboard. I'll be talking a little bit about later on. So tonight what we're going to be talking about is the icing on the cake, that top layer of the cake, which is the private sector. That's the sugary, that's what gives us the sugar rush. That's where all the money is in the economy. When we're talking about the stock market, really it is about that top layer. But I want to be clear that we could not have that layer of the economy. That would not exist without the other layers. So obviously the public sector is so important here in Canada. Without healthcare, without our education system, our economy would not be as strong as it is. There is the underground economy, that sort of that black market that I find fascinating. And I love kind of talking about that underground economy that often gets ignored. From there, we have the piece where it's non-monetized. That we often talk about the love economy. Now, how many people in the room have ever looked after a loved one, have ever sort of volunteered their time or looked after someone in their family for free? How many people have ever raised a child and took time off work to be able to babysit or to raise a child? How many people have ever volunteered their time for a nonprofit organization? Right? You are all contributors to that love economy. Now, obviously, because you didn't earn a dollar, money wasn't changed hands, that doesn't get counted by our measures of economic development like GDP, right? So oftentimes that gets completely ignored. From there, the last layer of the cake, that sort of dark chocolate layer, which is that nice sort of earthy soil color is Mother Nature. Because of course, without clean water and clean air and good food, none of the economy would exist. None of the other layers of the cake could possibly function without Mother Nature. So I want to be clear that tonight we are going to be talking about that sort of icing layer of the cake, that very sweet, rich segment, which is where the stock market resides. But I want to be clear that that would not exist without all of these other layers. Now, why do people invest? Well, it's very simple. It's this idea of compounding returns, right? Compounding returns are a beautiful thing when we can get them on our side. What I've done here is just illustrated a very, very simple graph showing you why it's important for people to be able to invest in the markets. What I've done here is I've run the model for 40 years. So this is a nice long time horizon. I've assumed a very, very simple a measure of $500 per month in savings. So assuming that someone is kind of just getting out in the workforce, hopefully they can set aside $500 every single month. I don't feel that that's sort of too much to ask. I think a lot of people are capable of doing that. Now, if we invest that $500 per month at a 7.5% annual growth rate. Now, obviously, this is a nice smooth graph. In real life, it's not going to be a nice smooth line. We're going to have the market go up and down. But if over the course of 40 years, we can get a 7.5% annual growth rate, you can see that an investor who starts with nothing 40 years later is going to have more than $1.5 million as a nest egg. Now, what's pretty wild about this graph is that most of that return comes in the final 10 years. That you can really see how that curve starts to bend, right? And this is the magic of compound returns, that oftentimes it's not about how much we're investing, but how soon we're investing. And so I always like to joke, there's the old adage that, the best time to plant a tree was 30 years ago. The second best time to plant a tree is today. It's the same thing when it comes to investing. The best time to start investing was, in this case, 40 years ago. The second best time to start investing is today. Now, one thing I do want to raise, because it's a bit of a pet peeve of mine, are these things called management fees. And you have to be really, really careful about how management fees can start to eat into your portfolio returns. Because what I've done here is I've just shown you the math. If you were to have a 1.5% annual fee, you can see that that eats away almost a third of someone's nest egg in retirement. And so you have to be really careful. So if you're working with an advisor or you're working with a salesperson, you always need to ask them, what is the annual fee on this product? There's an acronym. It's a bit of a bizarre acronym that's so important called MER, the Management Expense Ratio. And sadly, Canadians pay some of the highest fees in the world when it comes to our mutual funds. So it is important that we look at the fees inside the portfolios that we're paying in order to be able to really understand what it is that we're paying there. Oh, now I just hear my puppy in the background, so she might come in, pay us a visit. We'll see. Now, when I started to invest, when I started looking at my options, really it was, I came out of school in 2008. I did my master's in Sweden. I came home to Canada sort of ready to take the investment world by storm, and I graduated right into the crash. My timing was great. Now, a few years later, I was able to put aside enough money that I wanted to start investing my own personal funds. So I came across this lovely resource called the Canadian couch potato. Has anyone ever heard of the Canadian couch potato? Is this something that anyone's ever heard of? Oh, I don't see any hands there. Now, this is one of the most popular blogs when it comes to personal investing in Canada. They talk about this idea of buy and hold. Okay, so it's really, we're not trying to pick and choose individual stocks or individual companies. The idea is to buy and hold, and he advocates using these things called ETFs, exchange traded funds, that I'll get to in a couple of minutes. And what I've got here below is, I promised you a pie chart. This is a really simplified mix of a couch potato portfolio. And you can see here that we've got 40% in Canadian bonds. The remaining 60% is in stocks, split between Canadian stocks, US stocks, and international stocks. Now, I'm just going to take a quick minute to explain the difference between stocks and bonds. This is something that sort of investing 101. Some of you probably already know this, but just to get us all on the same page, I'll give you a quick little overview. So stocks are kind of like the rabbit in the race. Okay, when we buy stocks, we're buying shares in the company, and they're going to go up and down with the stock market. So they're kind of the rabbit in the race, where they'll go up and then they'll fall and then they'll go up. And over time, stocks have been the highest performers, have been the best way for investors to be able to make money over the long term. Bonds are more like the turtle in the race. When we buy bonds, we're actually loaning money to governments and corporations. So bonds are like debt. So when we're buying bonds, what we're doing is really, we're not planning to buy low, sell high. We're not trying to sort of shoot the lights out in terms of the investment returns. Instead, what we're doing with bonds is we're loaning money, and we're going to get a nice, consistent interest payment, often every single month. Right? So every portfolio is going to want to own a mix of both stocks and bonds. It's one of the most important ways for people to be able to diversify their portfolio. The reason we want to own both stocks and bonds is that they actually tend to move in opposite directions. They're what we call inversely correlated. What this means is that when stocks go up, bonds are actually going to go down by a little bit. But the reverse is true, that when stocks crash, and it's not if stocks crash, but when stocks crash, stocks are going to crash, bonds are actually going to go up in value by a little bit, right? And so they're going to be sort of the buffer in our portfolio, the little safety net there. And what's nice about this couch potato approach is that in a crash, stocks go down, bonds go up by a little bit. What we want to do is sell some of our bonds and buy stocks, because stocks are cheap. So by using this couch potato approach, we're not picking and choosing individual companies. We're buying sort of whole markets. We're buying the entire stock market, and oftentimes the entire Canadian bond market. And then what we're doing is just buying and holding, and then rebalancing our portfolio, usually about twice a year. We just go in, rebalance the portfolio. Very, very simple. Now, when I looked at investing my own money, I looked at this Canadian couch potato approach and buying these ETFs, these exchange traded funds that had all these different companies. But when I opened up the ETFs, I looked at the companies that are actually inside of the portfolio, and I saw some companies that I just couldn't bear owning. These were just absolute red flags for me, what I call sort of an ethical thumbs down. Now, these are mine, and I want to be clear, I'm not here to project my values onto anybody else. Right? Really, it's about looking at the companies inside, and people are going to determine on their own which companies are absolutely a no-go for you from an ethical perspective. So for me, Exxon is a no-go, not a huge fan of that company. Philip Morris, that's a tobacco company, so I wasn't too keen to invest there. Lockheed Martin is a military company, and I really don't like investing in weapons. TransCanada obviously is a pipeline with a lot of issues right now, and Barrick Gold has just done some horrible things on their mines sort of all over the world. They've got a pretty nasty history. Now, I'm just really curious, and maybe, in terms of a breakout, I don't know if you can yell it out for me or whether this is for later, but I'm just curious whether there are any companies that I haven't listed here that are on your personal sort of red flag list or your blacklist that you just would not want to own one penny of. Is there anyone in the room that has any companies that I'd love to hear that you just wouldn't want to invest in at all?
Monsanto or Bayer?
There.
I didn't. Can you repeat? I couldn't quite hear it. Rob, can you share it in the mic?
Monsanto or Bayer?
Yeah, absolutely. Monsanto. I get that one quite a bit. Bayer owns Monsanto, so they're facing major lawsuits right now. I'm curious, any other companies? Volkswagen. It's all good.
That was Volkswagen because of the emissions.
Yeah, that was a huge problem. Absolutely.
I hear a Kinder Morgan.
Kinder Morgan, yeah. So everyone's going to have a very, very different list of companies when it comes to this, right? And I want to be clear again. For me, it's not. I don't really care what companies are red flags. Everyone's going to have a different idea of this. Really, all I want to do is I'm just sort of looking at it and saying that these are the companies that for me are a no-go, recognizing that everyone's going to have a completely different list of those companies. Now, another kind of issue is, and you know, I understand that, you know, a lot of people here are going to be worried about their carbon footprint. So this is an extremely compelling infographic from an organization called CoPower. Because what they did is they measured the carbon footprint of an investment portfolio. And again, you know, it's fascinating to be able to look at this. Now, what they did for this data is they did assume a 100% equity portfolio, so no bonds, just stocks. And they assumed 50% international and then 50% Canadian. And you can see here the carbon footprint of a Canadian portfolio is huge. Right. And again, this isn't a silver bullet. So I want to encourage people, you know, travel locally. I would love to be able to explore BC and the opportunity that y'all have to be able to spend some time out in nature. You don't need to fly anywhere. You've got lots of beautiful places to explore there. You know, obviously, if people can ride their bike or buy an electric car or take public transit and, you know, burn less gas. Yes, yes, yes. Shifting towards a meat-based diet absolutely is a wonderful thing you can do to reduce your carbon footprint. But as this graph shows you, if you have $100,000 invested in the stock market, the carbon footprint from that investment portfolio is a heavier carbon footprint than all these other issues combined. From there, if you've got a $1 million portfolio, and I want to be clear, $1 million sounds like a lot of money. That's not enough for most people to be able to retire on in today's day and age as a nest egg. But if you've got $1 million stock portfolio, you can see how massive this carbon footprint is. And a big reason for this is because of the Canadian stock market. That when we look at the breakdown, that most Canadians have very heavy exposure to the Canadian stock market. And when we look at the top companies, which we're going to look at in a few minutes, you're going to see a lot of energy intensive companies there. That obviously, you know, the oil sands is a huge part of the stock market, and pipelines are a big part of that, and mining companies. And then obviously we've got the big banks that dominate the stock market. And what do the Canadian banks own a lot of? Right? They own a lot of fossil fuels and they own a lot of mining companies. So as Canadians, we are particularly heavily exposed to this carbon footprint. And this can be an absolutely huge problem. You know, and I'm really looking at it from an ethical perspective here, that obviously a lot of us are working hard to lower our carbon footprint. And most people just haven't even considered the impact of their investment portfolio. But it's more than just an ethical concern. There's also a major financial concern. Because how many people in the room have heard of this idea of a carbon bubble? How many people have heard of the carbon bubble? Okay. So this is a really, really important issue to understand. And this slide says so much. Because what's happened is that if we add up all the proven carbon reserves, so these are going to be all the oil companies, all the mining companies that own assets where the carbon is still below the ground, those assets right now are sitting on their balance sheets, and that we have roughly $27 trillion of proven carbon reserves. This is if we don't do any more exploration, we don't find any new sources of fossil fuels. Now, when we look at the carbon budget, when we look at the Paris Agreement, and if we're serious about keeping warming below 1.5 degrees Celsius, then we only have this carbon budget where we can burn only about $7 trillion worth of those assets, which means that the remaining $20 trillion could potentially be staying underground if we get serious about climate action. And if we get serious about climate action, and it's a big if, I'm not convinced that we're going to elect political leaders that are going to take this seriously and that we're actually going to do it, right? Like, I'm a bit of a realist there. But if we are serious about climate change, we are looking at potentially one of the biggest bubble bursts in the history of the stock market. To put this into context, right? The U.S. real estate crisis that we went through in 2008, 2009, in 2007, that real estate market was worth $13 trillion. It shrank down to $6 trillion. So that was a $7 trillion bubble that burst, causing that global crisis. We're looking at a potential write-down of 3 times those assets. So when we talked about this idea of toxic assets 10 years ago, and these, collateralized debt obligations, right, that just became worthless, we're in a similar situation where if we're serious and we take climate action, we could be looking at a write-down of almost $20 trillion in assets. Right now, those assets are sitting on the balance sheets of a lot of these publicly traded companies. Guess what's going to happen to share prices when that bubble bursts? It's not going to be pretty. So that's sort of the financial imperative to sustainable investing. And it's not all bad news. It's not all doom and gloom. It's not all about risk. There are also some amazing opportunities when it comes to sustainable companies being more profitable. This is a book from another mentor of mine. His name is Bob Willard. He was an advisor on my thesis, and he's just an amazing fellow. He's Canadian, and he literally wrote the business case for sustainability. Has anyone ever heard of Bob Willard? I'm just curious if he's made it out there, but he's just a tremendous, tremendous person. What he found is he did all this research. He found that companies that are leaders in sustainability are more efficient. They use less energy, less water, less resources. They're more productive because their employees actually care about the company that they're working for. And they're more innovative, meaning that they're producing organic and ethically sourced goods that are customers are willing to pay a higher price for. And they're also creating the next generation of technologies that are more efficient, right? And are kind of building those products and services for the next green economy. So I want to be clear here, there is a financial imperative to investing in companies that are leaders when it comes to sustainability. Now, if that wasn't enough, I've got another little set of data points for you. This is a project that I do with Hazel Henderson called the Green Transition Scoreboard. So back in 2010, after I finished school and before I kind of found a job and started my own business, we decided to start this research project. At the time, we knew, based on the best research that was available, that we needed roughly $10 trillion in private investments to kickstart the global green economy, to move us from sort of a dirty fossil fuel economy into a clean green economy. And I started counting. And every year, once a year, I run the numbers. I look at private investments in the green economy. I exclude government expenditures as much as possible. So this is private money. And what I found is more than $9.3 trillion flowing into the global green economy. Now, this is an aggregate number, so every year it gets bigger. I keep adding to it. And I'm just getting ready. Next week, I'm going to be looking at my 2009 update. And I'm happy to report that I'm very confident that we're going to hit more than $10 trillion, which means that we're going to hit our goal, that this audacious goal that we set 9-10 years ago, we're there. What I want to illustrate here is that this transition is happening, that I don't care that Trump's president, he did not manage to bring back coal, right? That green technologies are getting cheaper and cheaper, and this is where the money is starting to flow. And that I expect this to simply accelerate even over the next 10 years. But when I talk about the green economy, this isn't some, dream future, something that's going to happen in the future, but we're not there today. We are there today with investments in the realm of $10 trillion globally. This is happening. Now, when it comes to your investment portfolio, that's like the big picture, that's like the macro piece. Now I want to come back to the micro piece, to your personal investments. And when I come up with a roughly sustainable portfolio, I want to be clear that we're still going to be very, very diversified. We're still going to have bonds in our portfolio with a big chunk of it. Now, rather than doing a lot of corporate bonds, I prefer doing just government bonds, especially if you want to divest from fossil fuels. The best way to do it with the bonds, very easy. We just do government bonds. Simple, safe, boring. From there, we're still going to have plenty of stocks. We're going to have lots of US stocks and as well international stocks. We're going to make sure that we are diversified there. And I'm going to show you what these sort of doing less evil, socially responsible funds look like. But what I've done here is I've carved out part of the portfolio. Part of it is going to go into green stocks, what I call sort of doing more good. Part of it is going to go into what I call impact investments. These are going to be things like green bonds and community bonds. And now you'll notice that I've only done about 10% for each. Obviously, it's your money. You can do a little bit more if you want. But really, when it comes to green stocks and when it comes to impact investing, I want to be clear that these do tend to be riskier investments. So we want to be really deliberate about how much of our money we carve out for these higher risk things. Right? I don't want you to put all of your money into green stocks or all of your money into impact investments. These should be part of a nicely diversified portfolio. Now, these are two acronyms that I absolutely love, and I've got some examples when it comes to both of them. The first acronym is called ESG, Environmental, Social, and Governance Data. This is an acronym, this is code word for sustainability. And I'm going to show you what a sustainability score looks like very soon. The second acronym is called ETF, Exchange Traded Fund. Exchange traded funds are great because they're like a mutual fund in that they're a bundle of different stocks that are in there, and they're bond ETFs as well, right? But you're buying a fund, it's a bundle of things. But because we're buying it directly on the exchange, right, they tend to be a lot cheaper. The fees on ETFs tend to be a lot lower than mutual funds. They're also much more transparent. So if anyone's ever tried to get a full list of holdings and every single company that's in their mutual fund, it can get a little bit tricky to get the full list of holdings. Whereas with ETFs, I love how transparent they are. With a couple of clicks, I can get a full list of holding. And I'm going to give you an example of an ETF in just a minute. So first, I want to talk about this ESG score. Okay, so when it comes to environmental, social, and governance ratings, we now get this sustainability data on all these different publicly traded companies. And I could do it in real time. I could look it up, for individual companies. So in the Q&A, feel free to yell out a company and I can get this information for you. I get it for free through Yahoo Finance, which to me, it's kind of funny that Yahoo is relevant. What I've got here is a screenshot for the ESG score of Apple. Apple is the largest company in the world, so I tend to use them as the example. What you can see is that their total ESG score, they're in the 77th percentile, so not bad. This would be compared to other tech companies. You can see they have a very high environment score. Apple's been doing a lot when it comes to becoming a green company around renewable energy, procurement, looking at the different environmental things like a hazardous waste policy, and all these different environmental measures. Their social score is not great. They're only in the 41st percentile. This is because Apple, has a lot of issues within their supply chain. I don't know if people remember hearing the controversy with Foxconn. And they had a Chinese company that was a supplier that was really not treating their employers very well. And then their governance score is really bad. They're in the 16th percentile when it comes to their governance score. This is going to be things like separation of the chair of the board and the CEO. Those should not be the same person. I believe in Apple's case, Tim Cook is both the CEO and chair of the board. As well, this is going to look at issues like percentage of women on the board of directors. This is going to look at taxes paid. Apple has this nasty little trick where they hide all of their EU sales. They've got a shell corporation in Ireland, and that's allowed them to get away from paying a lot of their taxes, which would be a governance red flag there. As well, what we do is we do get this controversy level. So this is from a company called Sustainalytics. That's who Yahoo pulls this data from. What they do is they assess controversies on a scale of category 1 to category 5. Category 1 would be like a minor issue, like maybe a product recall. A category 5 would be like a BP oil spill. I'm guessing that with Apple, it was that Foxconn controversy that landed them a category 4 controversy, which is pretty bad. What's also kind of cool about the Yahoo Finance tool is that we can get these different product involvement areas. So we can see whether a company is involved in alcoholic beverages, adult entertainment, gambling, all these different things. So it's really interesting. If we do want to get research on a company by company level, we can now look up these companies to see whether, for example, they're involved in military contracting or controversial weapons. I'm writing a report tonight looking at Boeing. Obviously, Boeing has been in the news lately, so we're going to do a little piece about them. And a major red flag for Boeing is that they are a big manufacturer when it comes to military weapons. So when it comes to this idea of like sustainability data, we use this acronym, environmental, social, and governance scores. This information is now widely available for all these different companies and lets us make smarter decisions about what kind of companies we want to invest in. What happens is from there, these ETF companies are going to take that data and use it to build a fund. So what I've done here is I've taken the most popular ETF in Canada, which is the TSX 60. Have people heard of this index before? Has anyone heard of the TSX 60? This is like, see a couple hands. So the TSX 60 is the 60 largest companies in Canada on the Toronto Stock Exchange. Very simple. From there, what I've done is I've compared it to something called the Janssy Social Index. Has anyone ever heard of the Janssy Social Index before? So this is like the benchmark. This is the most popular socially responsible fund in Canada. Now you can see they're very similar. They have a lot of very similar holdings. Royal Bank, TD, Suncor is in the socially responsible one. And if people take issue with this, I'm happy to explain how that got in there. But what's interesting to me is less about what's in there and more about what's not in there. And you can see that certain companies have been excluded from the Janssy Social Index. Notice Enbridge is not in there. That's because, I don't know if people remember, but a few years ago, Enbridge had a major oil spill in the Kalamazoo River. That was a massive environmental disaster. That got ranked as a Category 4 controversy, and Enbridge got kicked out of the Janssy Social Index. As well, you'll notice that Bank of Nova Scotia, Scotiabank, is not in the Janssy Social Index. That's because the methodology that they use is that they rank all those companies with that ESG score and they kick out the bottom 20%. So because Bank of Nova Scotia, right, is in the bottom 20% of Canadian banks, they're not in the Janssy Social Index. Now, as well, with the methodology, they will use what we call, they'll exclude quote unquote sin stocks. So responsible investing was started in Canada by the Mennonite community. So the Mennonites kind of got to decide the first list of exclusions. So we're also not going to have alcohol and military and tobacco and gambling and pornography, and I believe nuclear is part of that screen as well. But what's interesting is that oil and gas, that a lot of these methodologies were developed before we really understood climate change. So you'll notice that, Suncor is still in here as well. Pipelines will still be in a lot of these socially responsible funds, which I know is going to be a problem for some people in the room. They're going to look at it and be like, why is Suncor in there? And again, it's because they haven't been screened out. They haven't been explicitly screened out. There's going to be a really interesting conversation coming up, I would say in the next year or so, with the rise of cannabis stocks. And a fascinating question that I'd love to explore is, should cannabis be excluded from socially responsible investments? If we're going to exclude alcohol and tobacco, shouldn't we exclude cannabis? Well, I don't know. The jury's still out on that, on whether it should be or not. But it's going to be really interesting for me to see. And again, there are lots of different definitions when it comes to these sort of doing less evil funds. What I'm showing you is a very basic one. There are ETFs on the market now that are both socially responsible and fossil fuel free. And there are new ETFs literally coming out almost every month. Desjardins just released a new socially responsible ETF that is fossil fuel free. They released it on March 7th. So that's like literally 2 weeks ago. There's a new fund that's available. So even if this Janssy Social Index doesn't go far enough for you, don't worry. There are options for you. What I'm trying to do here is just to illustrate the difference between a traditional fund, a traditional ETF, and the Janssy Social Index, which is a responsible ETF. The reason I like to illustrate the difference is because so many people automatically assume that we need to sacrifice financial performance, right? I get this all the time where people are like, oh, that's so great. You want to do good in the world. You want to, support sustainable companies. Well, I'm in this to make money. Well, check this out. The socially responsible ETF has actually done better than the TSX 60. So if we look at the performance over the last 5 years, the pink line is that Janssy Social Index. The blue line is that TSX 60. And responsible investors in Canada have actually made more money than traditional investors. It's fascinating. Now, that's sort of the doing less evil side. Now I want to take a few minutes and talk about the doing more good side of things. So again, there are lots of different green ETFs, and there are all kinds of them. As well, we're going to talk a little bit about these impact investments. I've got a cool example for you. In terms of the green ETF, my favorite one is this one called the Invesco Clean Tech ETF. The ticker symbol is PZD. This is a very broadly diversified definition of clean technologies. So again, we buy this one fund. We get exposure to a whole bunch of different green companies. I just took a screenshot to show you, a few of the top holdings. I don't expect people to recognize too many of these, so I'll just give a quick little overview. Trimble Navigation is the world's most precise GPS system. So this is used by a lot of companies like FedEx and UPS to be able to make their routes a little more efficient, save them energy, save them money. Autodesk, has anyone ever heard of Autodesk? They make software called AutoCAD. Awesome. See a few hands there. Borg Warner, they produce components for electric vehicles and autonomous vehicles. Siemens Gamesa, so you might have heard of Siemens before. They're actually in this fund a little bit lower down. This is their wind turbine division. So Siemens Gamesa makes wind turbines. Johnson Controls does HVAC systems, high efficiency heating, ventilation, and air conditioning. Xylem is faucets and water infrastructure to make it more efficient. And Cree are LED lights. And I love LED lights. They're just so darn efficient. So again, this is a wide range of different green companies. There's a little bit of renewable energy, a little bit of energy efficiency, a little bit of water infrastructure. This is kind of the most diverse option when it comes to green companies. And what I like about this is that I really want to caution investors not to pick and choose specific technologies. I've seen too many people kind of lose their shirts betting on a specific company or a specific technology that they think is going to change the world. And then if it doesn't, you can lose a lot of money in this sector. So I really like being broadly diversified here. From there, I've got a cool option for you in terms of doing more good on the bond side of the equation. So this is an organization called CoPower. Has anyone in the room ever heard of CoPower? A couple people. So CoPower is a green bond. And what they do is they build a whole bunch of different green infrastructure projects, including community-owned solar projects, I believe they did a whole bunch of geothermal projects in British Columbia, residential geothermal. As well, they've done a lot of LED retrofits for condominiums. So condo LED retrofits, which are just absolutely brilliant. The way it works with CoPower is that we're buying a bond. So we are lending money to these projects. We are locked in. So with CoPower and all these impact investments, one of the big risks is that you can be locked in this case for either 4 years or 6 years, which is a risk. So again, you wouldn't want to put all of your money into something like this. But, you know, if you're willing to accept that your money's going to be locked in for 6 years, you can earn 5% annually while investing in green infrastructure projects. So again, this is a way for us to actually earn a little bit more than traditional bonds, right? Interest rates are so low right now, it's pretty rare to get that high of a return from your bond. Now, again, there are some risks here, right? So understand the risks. Don't put all of your money into something like this, but this is a way for us to have a positive impact, a direct positive impact by investing in green infrastructure projects while also earning a decent return on investment. So, because everyone is always concerned about financial returns, I ran the figures yesterday, and as of yesterday, these are the financial returns that my model portfolios have achieved. So I've compared it to a traditional couch potato portfolio. So that's kind of my standard benchmark, is using that very standard couch potato portfolio. You can see the 1 year performance as well as the annualized performance. So that's the average annual return over 3 years, 5 years, and 10 years. From there, what I've done is shown the performance of my organic couch potato portfolio. This is probably my most popular portfolio on my blog. I took that couch potato approach, and by doing a mix of sort of the socially responsible and the green ETFs, you can see that it's done a little bit worse over the last year. But my organic couch potato portfolio has outperformed over 3 years. 5 years, over 5 years, it's very similar, and over 10 years as well. And then I've also got my fossil fuel free model portfolio that, again, those are on my blog, sustainableeconomist.com. And my fossil fuel free portfolio has actually outperformed over each of the 1 year, 3 year, 5 year, and 10 year periods. Now, I want to be clear that, you know, I'm not here going to promise that it's going to outperform every month or every year. I don't have a crystal ball. I can't promise that these things are going to continue to outperform. What I can promise is that they're going to do about the same as a traditional portfolio, that all the evidence that I have suggests that these investments should do about as well, if not a little bit better, than traditional investments, but while actually letting you feel good about your investments. So there's no need to sacrifice returns. And certainly if you accept that climate change is real and that the economy is really quickly moving in this direction, then obviously I would expect these portfolios to continue to outperform into the future. Oh, we're getting a little visit here from my pup. She's being a handful. From here, I've got my change theory. So really, this is the change theory that I'm operating based on. What I'm hoping to do is to get as many people as possible to invest in this manner. Because when more people invest, that creates more demand for those shares. When there are more people buying rather than selling, the share prices are going to rise faster than those companies' peers. As the share prices rise, we're going to start to see that continued financial outperformance. And assuming that markets are perfectly rational, right? And we can debate whether they are or not, but assuming that investors are rational, if we continue to get financial outperformance, that's going to result in even more people investing in socially responsible and green companies. So what I'm trying to do here is to create this positive feedback loop where more people are investing, they're making more money. Because they're making more money, more people are investing. And if I'm successful in getting this loop going, then we're in a situation where very quickly we're going to have companies competing with each other to be more sustainable. And we're going to go a long way towards creating that sustainable economy. That's why my mission is to help 1 million people invest intentionally. And again, I don't really care what those intentions are. So I don't care what companies you want to avoid, right? Everyone wants to avoid different things. That's fine. But what I want people to do is actually look at the companies inside their portfolio and make a deliberate decision about what they're investing in. What I've done is created my business model, which is one-on-one coaching to help people. And this change theory, this explains a lot of my business decisions. This explains why I'm volunteering my time to talk to a room of people right now. This explains why I have a sliding scale in terms of my hourly fee, so that I don't have to turn anyone away because they don't have as much money. This explains why I put a lot of my research on the internet for free, so that if people can just copy my ideas, fantastic. Because if more people are doing this, I'm going to be benefiting from that. The last thing I want to talk about are the practical questions. That there are several different ways for you to be able to invest sustainably. There are some amazing mutual funds on the market from companies like Desjardins, NEI, which is Northwest Ethical Investments. RBC has a fossil fuel free mutual fund. Like, this is now becoming mainstream. Most traditional financial institutions do have a socially responsible or sustainable mutual fund. As well, we do have the new generation of robo-advisors. Has anyone in the room ever heard of Wealthsimple? Right? Wealthsimple does a lot of advertising. As well, we've got Modern Advisor and Quest Wealth, who are all robo-advisors that have socially responsible options. Now, again, I'd want you to look at the companies inside and go through it. It might not go far enough for you. If you're like me and a lot of those sort of more traditional things, the traditional definitions of socially responsible don't go far enough, then in that case, your best option is going to be to do what I call self-directed investing. This is learning how to invest your own money online. This is going to be the cheapest option. It's going to have the lowest fees. It's also going to allow you to pick and choose, to customize your portfolio based on your values. To be clear, I've done a vegan portfolio. I worked with an anarchist, all these different people with all these different values, right? And the way that I'm able to handle that and kind of customize it based on those unique values is by going the self-directed approach. This is where you can use a platform like Qtrade or Questrade or TD Webroker or RBC Direct Investing or Scotia iTrade or any of these different online investment brokers. And what you can do is learn how to manage your portfolio using socially responsible and green ETFs. That's going to be the cheapest option. It's also going to allow you to have sort of the most sustainable portfolio. From there, if you do want to get started, I always get this question, how do I get started? The best thing is always simply to ask questions. So ask. If you've got an advisor, ask them questions. If you don't have an advisor right now, if you're doing it yourself or whatever, you can use Google, put these questions into Google. There's a good chance you're going to end up on my blog. And really understand what are your responsible fund options. What's available to you? And like I said, a lot of the banks, they have these options available. So it might just be as quickly as just switching to the responsible option. From there, I would strongly suggest you look at the companies inside, and not just the top 10, but I want you to see all the different companies inside and decide for yourself, where do you draw the line, right? Look at the companies inside. And if you have a reaction, know that, you don't have to invest in those companies. There are other options for you. From there, you're going to open up an RSP or a TFSA account, and you're going to purchase the funds, the socially responsible or the sustainable funds. And from there, you're going to profit, assuming the stock market goes up. And I want to be clear that when it comes to these socially responsible and sustainable investments, they do still follow the market. So if the stock market does well, your investments are going to go up. But if the stock market falls, your investments are going to fall. But obviously what we're going to do is wait. And if there is a crash, we're going to stay patient. And if anything, that's a good time to get aggressive and buy more, hoping that it will bounce back up as it always has. So that's my presentation. That's all the information I've got for you tonight. I've sent Rob my slides. So, Rob, feel free to distribute them if you've got an email list, or, that said, if anyone wants to send me a quick email, I'm happy to share my slides with you. From there, I'm ready for your questions. Thank you very much for listening.
Give Tim a great hand of applause. I love your vision, mission of moving 1 million people to sustainable investment. Thank you very much. So, folks, the plan now is to ask away. Like, what is the questions you have? Tim is able to handle any type of question you've got. He does this all the time. So, anyone want to go first? At the back, we've got Michael Meta. Go ahead, Michael. Speak loud.
I'll speak loud, maybe I'll relay it a lot. So we talked about investment. What about if you have to take on debt, say you do a mortgage? Is there an equivalent to have a mortgage that is?
So the question is, oh, you heard that, did you?
Yeah, I heard that, around a mortgage. So there are two pieces to it, the financial piece and then the ethical piece. I think you're asking more about the ethical piece. So what I would say is that right? Okay.
Yes.
So I'm a big fan of the credit union system. When you're borrowing money, we're not really investing it. So it's not like we're leveraging, any investments when it comes to that. I love doing business with my credit union just because it does keep things more local. But the fact is that it doesn't really matter, in terms of your debt. I wouldn't say that it's sort of like more ethical to get a loan from a credit or from a credit union rather than a bank. That said, you might get better terms. So really, when it comes to mortgages and debt, really my best advice is just shop around, get the best rate and the best terms that you can. And I would make sure that as you're shopping around, make sure that you do include your local credit unions on your laundry list. That said, I've written a lot about the impact of when you deposit money in a bank account, a checking or savings account. There's this whole system that we have where, our deposits are then leveraged as debt by the banks or credit unions. So I would say there's a very strong ethical imperative to keeping your savings, your checking and savings account at a credit union versus a bank. But to be honest, when it comes to a mortgage, I don't see a huge ethical difference. You're borrowing the money. So if you have strong feelings about who you're borrowing from, then, you could consider that. But I would just take the best financial terms you can get.
Great question. Next question.
Follow up on that. You mentioned that having your checking and savings in a bank allows the bank to finance or lend to some industries you might not like. Is that also true with investment firms? If you have cash in your investment account, is it the same?
That's an interesting question. I'm really guessing it would depend on who that cash is with. So we use this thing, and forgive me, let me just bring up, because I've got a little a blog post that I did on why credit unions are awesome. And so what it comes to, there's a very specific term when it comes to having that money in the bank account, and the term is fractional reserve banking. And so the way banks work is they take our money that's in our checking or savings account, our deposits, and they loan that money out, right? And we know that they do this. The trick is that, if I think, okay, if I deposit $1,000, we know they need to keep, let's say, 5% of my money in the vault, that they're going to keep, $50 in there, 5%, they're going to loan it the other $950. That would be the assumption. That's actually not the case. Instead, what ends up happening is they end up keeping effectively the entire $1,000 deposit in the bank, and they create $19,000 out of thin air. to be able to loan out to other to companies and to people that want to borrow money. Now, this is a kind of a messed up part of I remember when I taught economics, this was always the part that would sort of blow my students' minds. You know, how come banks can just create money out of thin air? But they can. And they do it in this ratio of, at a minimum, 19-1. Now, I don't know whether investment firms are able to use fractional reserve banking. It wouldn't surprise me that if you had that cash and if it was with a bank, that would count as capital, as a capital reserve, which would allow them to loan it out. But if it's with a company like, you know, let's say Wealthsimple or, you know, one of the mutual fund companies, I don't think that they are legally allowed to use that fractional reserve banking in the same way. But that said, if you are planning on having cash in, you know, an investment account, in my experience, they usually offer like 0 interest rate. Like if I keep money, I've got a Questrade account. If I keep cash in Questrade, I'm not earning any interest on that. So for me, what I tend to do is any money that goes into my investment account, I want to actually invest that. If I have cash as savings, I'm going to open up what's called a high interest savings account. So I've got one, the one that I use is called Alterna Bank. Alterna Savings is my local credit union, and they've created Alterna Bank, which is national. So even you in BC could open an account with Alterna Bank and open a high interest savings account. And you can open a high interest TFSA. I'm pretty sure you can do a high interest RRSP. And I earn, I believe, 2.35% on my high interest savings account. And obviously, because that is a bank, that is a financial institution, right? They are going to be using the fractional reserve system to be able to take my deposits, multiply that by, let's say, 19 times, and then loan that out. And because it's Alterna Bank, right, it's with the credit union system, it's much more likely that it's going to go out to loans, to mortgages, and to small business loans, rather than corporate financing for large multi-billion-dollar companies. Does that answer your question? I'm not sure. I might have gone off on a tangent there.
That was great. We got a question at the back. Speak up.
Yeah, that was a great tangent. You know, and I'm very interested in the fractional reserve banking system, but also the inflation that it creates.
Sure.
From some of my readings, I found out about treasury inflation savings or securities. It's an investment tool that you can use in a market that's prone to high rates of inflation. And I was just wondering if you have any suggestions on tips that might be environmentally supportive.
Right. So, okay, so it's tricky. Really what I heard there, and it was a little choppy here and there, but really what I heard was around inflation and looking for investments. If you're concerned about inflation, you know, how can you sort of invest your money in terms of from an environmental perspective? Am I right there, Rob? Did I get that right?
Is that right?
Yeah.
Yes.
Perfect. So really when it comes to inflation, you know, there is going to be inflation. And frankly, there does need to be some inflation in the market. Inflation is not necessarily a bad thing. We do need to have that little bit of growth, right, in the money supply in order to keep things churning. What it means is that inflation does get out of hand when it gets too high. Then we can get into hyperinflation and all these other types of problems. You know, a lot of people will use gold as a hedge against inflation. I'm not a huge fan of gold. Obviously, there are a lot of ethical implications. A lot of the gold mining companies I'm not a big fan of. And I also just don't like having gold around. You know, it's not very liquid. It's hard to sell, and you end up getting ripped off between the price you pay to buy it versus the price when you sell it. It's not very good. So I don't like having gold. For me, the hedge that I use against inflation is very simply the stock market. That, you know, in a scenario where we do get a lot of inflation, right, the economy would be overheating in that scenario. I would expect valuations to go up in accordance with that. And I would expect share prices to get inflated in accordance with that. So for me, that's kind of my hedge against inflation, is just simply owning green stocks. And obviously I'm not going to put all my money into the green stocks. I'm going to do a mix of the doing less evil as well as the doing more good. But that's really what I have as sort of my personal hedge against inflation.
Question over here, Mike?
In terms of social indexes, is there any consideration of the recognition of UN Declaration on Rights of Indigenous People and the relationship with First Nations that these companies have?
I wish. Sadly, I have yet to see any recognition of that specific UN declaration. I see a lot of the UN Global Compact. And the UN Global Compact is now starting to bring those issues in, but I have yet to see any index that specifically addresses those concerns. And I got to tell you, I think it's sad. I think we're overdue for that. That's a question that I do get a fair bit. And sadly, I don't have a good product or a good answer for you on that. All I would say is that, that's an issue that is emerging very quickly. And that my hope is that we will see ETFs and indexes in the future that do recognize it. But sadly, my answer is not yet.
I asked that because I saw CN on your list there.
Yeah. Yeah. So, I mean, it's a huge issue. And there are pipelines on there as well. Right. And so for me, this idea of free and informed prior consent, is to me kind of a fundamental issue. Right. And certainly something that I would not want to invest in companies that are violating that issue. So, there's one I've seen, there is an ETF on the market right now, the Horizons Global Sustainability Leaders ETF. The ticker symbol is ETHI. One of the issues that's popped up in their screens is mandatory detention of asylum seekers. And that issue popped up because the ETF first was created in Australia, where mandatory detention of asylum seekers is a huge issue in Australia. So I think you bring up a really, really good point. I think that this is an issue that is, to some degree, probably much more important in Canada rather than other countries. I'm happy to sort of carry that banner with you when I'm talking to the different index providers that, this is something they should be concerned about. But again, this is a question that if more people are asking this question and sort of pushing for this type of product, then I would hope that the Canadian fund companies will respond to that in the way that they respond to that Australian concern.
Great, thanks, Ken. What do you got for a question?
Hi, Jim. Thanks for a great presentation. Followed you one way or another for about 5 years, and some of the things you mentioned earlier, we actually acted on, so very grateful. My question concerns asset mix and life cycle. I'm 61, I'm not retired, but it's on the horizon.
Yeah.
I probably want to be a bit more careful. I wish I'd had this conversation 20 years ago. Would you have any advice or cautions for persons like myself? I love the idea of co-power, 4% over a 4-year commitment, but 4 years, even at 60, maybe my advisor said, hey, that's a long time, maybe think twice. Anything about the situation I'm in my place in the life cycle? Yeah,
great question. So absolutely, that asset mix, that pie chart should shift over time. The general rule of thumb that we use is that the starting point for the conversation is that the percentage of bonds in your portfolio should roughly be about your age. So, someone who's young, who's got more time, they can take more risk. If someone's 20 years old, they should be about 20% bonds, 80% stocks. If someone's 80 years old, they don't have time, right? If there's a stock market crash, they could be in trouble. which means that, you know, they should be closer to 80% bonds, 20% stocks. However, so Ken, to answer your question, you know, the starting point that I would have for you is, you know, I'll round you down. I'll be generous and say roughly 60% bonds, 40% stocks. However, bonds, you know, interest rates are just so low right now that traditional bond funds pay, you know, next to nothing. Like, you know, I think my government bond ETF pays between 2.5% to 3%, which is just, you know, barely keeping up with inflation right now. So for that reason, a lot of people in your situation, rather than doing so many bonds, will go for a bit of a middle road approach and we'll look at high dividend paying stocks. And high dividend paying stocks tend to be more stable. Certainly, they're not going to be as volatile as growth stocks, like let's say technology. And so a lot of clients in your situation really love gravitating towards these, what I call renewable energy utilities. So these are utilities that own renewable energy projects like solar farms and wind farms and hydro projects. The biggest one in Canada that I can point to is called Brookfield Renewable Energy Partners. And I'm just going to look them up right here so I can get you the most recent data. And Brookfield Renewable Energy Partners, this is a company that trades on the Toronto Stock Exchange. And they are right now paying a dividend of 6.5% per year. Now, obviously, there is still some risk there. But this would be a way for you to be able to get sort of, you know, be 100% liquid, so no lock-in, still earn 6.5% per year, investing in renewable energy projects, understanding that there is some risk there, more so than in a bond, if the company does, you know, run into a huge problem or does go bankrupt, that the share price would fall to zero. But I would say that, you know, that's where a lot of clients are looking in your situation, is to still do the sort of doing less evil stocks, still have maybe a little bit of growth stocks, although it should be a very small percentage, to have like a decent percentage of bonds. You know, you would still have in the range of sort of 40 to 45% bonds, but, you know, you could easily carve out part of your portfolio for these high dividend paying green stocks. If they're Canadian, they're eligible for the Canadian dividend tax credit, which is very tax efficient to hold in an unregistered account if you've got your RSP and your TFSA maxed out. But that's the type of thing that, you know, if you didn't want to do so many bonds in your portfolio, I would look at that. You know, all respect to your sort of financial advisor, but they do tend to look very poorly at things like CoPower, often because their systems are inadequate in terms of letting you buy them. This is what we call a private placement. So oftentimes, if you want to buy something like CoPower, you're not going to be able to do it through your advisor's firm. You would have to do that on your own. And sadly, what that means is that you would be taking your investment sort of off their books, which means that they're not getting any fees on those. So forgive me for being a little cynical here, but I have heard some advisors that do kind of, you know, say they sort of overhype the risks, right? Because they kind of don't want you to take your money and put it somewhere where they're not earning any commission or any fee on that. So, you know, in my mind, having you lock in for 4 to 6 years with part of your portfolio, especially if you're still working, you know, it totally depends on your retirement plan and when you're planning to stop working, when you're planning to start receiving the income from your portfolio. But to carve out, you know, even if it's 2 or 3% of your portfolio for green bonds, I would have no problem with that. You know, obviously you'd want to be deliberate about it and do it in a smart manner. But those are kind of some of my thoughts for someone in your situation, that I wouldn't have a huge problem with the lock-in factor, as long as it's a small percentage. And if you don't want to put so much of your portfolio into bonds, you could look at high yield or these high dividend paying green stocks.
And we've had Brookfield for a number of years and it's done well, and I think it was your suggestion, so thank you.
My pleasure. Always happy to help. There are others kind of in that, realm, of those sort of renewable energy utilities. And really it's a way just, especially for people who are a little older who can't take the risk of owning some of these green technology companies. The green tech stuff, it can be quite volatile. It can be quite risky. So we would only want to do it with a longer term horizon. But what's great about the sort of sustainable investment field is that there's really something for everyone. So it's just a matter of figuring out what makes sense for you based on where you are in your life cycle.
So I have a quick question. What about a laddered government bond? Is that something to look at?
Yeah, I mean, that would be a government bond ETF. To me, it doesn't matter whether it's laddered or whether it's kind of a mix of short-term, medium-term, or long-term bonds. But absolutely, there's a great, laddered government bond ETF. But again, interest rates are so low, right? So when I look at the yield on that, it's not going to be very high. It's going to be very safe. It's going to be nice and boring and safe and steady and sort of the turtle in the race, but I'm looking at it. It's got a yield right now, that 1 to 10 year laddered government bond ETF, roughly about 3% a year, which is obviously sort of nothing to write home about.
I got a question over here.
I got a question. So you talk a lot about bonds. We're talking about how low the rates are. Something you haven't mentioned tonight is preferred shares.
Sure.
Do you have a thought on those?
Yeah.
I my portfolio, and I find you get a better return. They're pretty stable.
Yeah. So, for me, it's the type of company that offers a preferred share, is a type of company that's already paying a big dividend. It's going to be sort of a nice stable. It's a lot of the bank stocks and a lot of the sort of the big financials. The issue that I have, and just to explain to people what a preferred share is a preferred share means that you are first in line to receive the dividend. So if a company announces a dividend and, oh no, let's say they actually don't have enough cash to pay the dividend to everyone, the preferred shares kind of get first dibs on that cash payment, right? So that's the upside of owning preferred shares. The downside is that you are paying a premium. You are paying a higher price for that preferred share. And in my experience, it's rarely kind of worth it to pay that premium for the preferred share. I'm just perfectly happy owning the traditional share. Now, I'm in a place where, I don't live off my dividends, right? I'm 36 years old, so any dividends that I'm getting, I'm just automatically reinvesting those dividends. So for me to miss a dividend payment or not get the full payment from my common share, I'm not stressed about that at all. That's why for me, it's just really not worth it to pay the premium to get the preferred share. That said, if you were depending on that dividend to for your cash flow, right, and you were living off that, then absolutely I would understand paying a bit of a premium in order to ensure that you're going to get that, or not ensure, but have a higher degree of probability that you're going to get that. But for me, in my case, I just buy the common share. I don't think it's really worth it to buy the premium, but to each their own.
Next question. What percentage of the TSX 60 is it 22% fossil fuel? What is it?
I can bring it up. Hold on. Here we go. And I can share my screen with you. Hold on. Give me 1 second. So let me share my screen again. Okay. So I've got here the TSX 60. Can everyone see my screen?
Yeah.
Perfect. So I'm going to go down to exposure breakdowns. This is the breakdown by sector. So again, this is the TSX 60, the standard benchmark. You can see it's overrun by financials, big banks and insurance companies, 37%. Energy, which is going to be oil and gas and pipelines, are going to be about 20% of the portfolio. And then materials, which are mining companies, and there are a lot of global mining companies that are on the TSX, that's going to be about 9.6%.
Thank you. Other question?
Do you have any good resources around, say, peer financing?
So like if I have a rental property that's looking for someone to invest as a mortgage holder, essentially.
Right.
Then be able to connect directly that way and pay a better rate than a regular bond, but
Than a normal one. So there is this emerging field called peer-to-peer lending. I don't know if anyone's ever heard of peer-to-peer lending, but there's a company called Lending Loop, and Lending Loop facilitates peer-to-peer funding. So, the way that would work is you would basically list it online, and you would say, here's what I'm going to use the money for, and here's how I'm going to do it. Now, in my experience, those are just going to be debt. So you're just simply, people are going to be lending you the money. You're going to be borrowing it and paying an interest rate. And the hope is that you would be paying a lower return, to a peer rather than, an interest rate to a bank. So that's what I would suggest. There is this kind of emerging field called equity-based crowdfunding. This is more in like the venture capital. So the only way I can see it relating to real estate in the way you're describing is if you were to incorporate your real estate business, right? That's a scenario where now all of a sudden you have a corporation and you can issue shares. And so equity-based crowdfunding, it's like Kickstarter or Indiegogo in that it's crowdfunding. You're sort of, accepting investments from the crowd, but rather than, giving people perks like T-shirts or, early access to a music album, instead what you're doing is actually giving equity in your company. So, Lending Loop would be on the debt side. On the equity-based crowdfunding, there's a cool company called Front Funder. It's like funder without the E. It's like FUNDR. And that would be an equity-based crowdfunding site. I don't play around with that stuff too much. Honestly, it's pretty high risk, especially the equity-based crowdfunding. That said, I do have a couple clients who like the high-risk stuff, and they're willing to carve out part of their portfolio for what I call mad money. And, and those are the types of things that they can use their mad money in order to get a higher return. If you're looking to borrow that money, to raise that money, I don't know whether it's worth it for you to do that versus go to a traditional lender. Certainly to do it, it's going to take a lot more work. You have to run a campaign and convince people to invest in you. But that said, I have seen some people use it for really good success. I know someone who, basically got their student loan to do their PhD at a foreign university. They weren't eligible for OSAP or any of the government loan programs, and they're having a hard time at the bank. So they did it through Lending Loop, and they were able to raise the money to be able to do their PhD. So, I would say take a look at it. It's early days when it comes to that market, so I don't have a huge amount of information for you.
So it's maybe one more question, and we'll let you go.
I'm doing pretty well. I gotta say, I'm not falling asleep on you at all, am I?
You got it.
Thanks, Tim. Just wondering if you have, how much should an investor pay to their advisor overall?
Ooh.
Percentage. I mean, what's high, what's low?
Yeah. So there are different models, okay? And so let me just walk you through the different models in the investment industry. So the highest fee is going to be mutual funds, where the average MER in Canada, this management expenses ratio, code word for annual fee, is 2.25%, 2.25%. Which means that mutual fund companies get 2.25% of your money, however much you have invested in that fund, and they're going to collect that no matter what the market does. So whether it's up or down, they get their fees. Okay? Now, that 2.25% is broken up between the management fee that you're paying for the portfolio manager of that fund, and then there's another piece called the trailing commission. The trailing commission is what your advisor is actually receiving. And that's usually in the ballpark of about 1%. So of that 2.25, 1.25 goes to the portfolio manager and the legal and all the trading costs and all that stuff. And usually about 1% goes as a trailing commission to the salesperson that sold you that fund. Now, sometimes if they work for a company, sometimes they have to split that 50-50 with the company, right? But really that's going to be like the trailing commission is the fee that you're paying to the advisor. And some advisors are totally worth that trailing commission, and they'll meet with you and they'll teach you and they'll come up with a plan and they will totally earn that trailing commission, whereas others don't. I've met a lot of people that just walked into a bank, said, I want to open up an RSP. Oh, here's Jim. And they'll talk to Jim and Jim will sell them a mutual fund and they'll never hear from Jim ever again. But Jim will continue to earn that trailing commission every year as long as they stay invested in that fund. So that's the highest fee structure, are mutual funds. From there, below that, you have what I would call a fee-for-service advisor or a broker. Oftentimes, these are called fee-based accounts. So this is someone who is going to be a full-service person that's going to be doing it for you and managing the money on your behalf. This is the model that my dad uses. So my dad was a broker. He was with Midland Walwyn. Then they got bought by Merrill Lynch. Now he's with National Bank Financial. And when I was a kid, he was a broker. So he would actually get paid based on the commission every time a client bought or sold. So that meant he was always on the phone trying to convince people to buy or sell. Now that industry has really shifted from the broker model into the fee-based model, which means that my dad collects 1% of assets no matter what the person owns. Now, if that person owns ETFs, the ETFs have a fee, so it's going to be 1% on top of the ETFs, right? Whereas if it's individual companies, then there's no MER with individual companies, which means that he just collects that 1% flat. And I would say that would be like the standard fee for a full service firm. Now there are things like pooled funds or segregated funds, like there are all these different models, but I would say, sort of for full service, in the ballpark of sort of 1 to 1.5% would be a reasonable fee to pay. Now, if you were to go self-directed, now you're in a situation where there's no one that's going to do it for you. You're learning how to do it yourself. So that's why the way I get paid is by the hour, that I'm not a broker or an advisor. And so you would pay me a fee, and I charge anywhere from $150 an hour up to $750 an hour, right? Just because I can save people so much money. And that by learning to do it yourself with ETFs, I can get your fees down to usually roughly around 0.5% per year, right? So obviously a lot cheaper than the full service, but you're not getting the service, you're doing it yourself. Way cheaper than a mutual fund. I'm talking like a fraction of a mutual fund. And what's great about these ETFs is that there's a bit of a price war going on where the prices are coming lower and lower. So there's a company called Vanguard who is known for their very, very cheap ETFs. And they just released their first socially responsible or ESG ETFs. And the fees on that are about 0.15%, which is so unbelievably cheap. And this is diversified. This is like owning every stock on the market except for, fossil fuel extraction, military, alcohol, tobacco, those sin stocks. And then they've also added in the fossil fuel, just the companies that own the reserves. So pipelines are still in there, and Monsanto or Bayer is still in there. And, it's not perfect. But if the goal was to lower your fees as much as possible, that's like the cheapest option I have. But obviously in that case, you are doing it yourself. And I can see you're in the front, so, it's a little blurry, but I can see some gray hair. So, it makes me think you might be approaching retirement soon. So it does get a little bit trickier managing your own money in retirement. Although what's great is that, you could hire, again, an hourly coach or a consultant, someone to do a detailed retirement plan for you, where, again, you would pay us like a flat fee. And then you would then have the information to be able to make your own decisions and kind of optimize things for how you want to withdraw your funds in retirement. But really, that's kind of what it comes down to. Mutual funds, 2.25%. Full service, anywhere from like 1 to 1.5%. I would say ballpark, you know, and then hopefully you're getting good service there. And then do it yourself, you know, from 0.5% all the way down to like 0.15%. Is that helpful?
I think we're going to call it there unless there's anything pressing. Is there something else you had there? One more question? Okay, we got one more question. Go ahead.
Hi, Tim. I really want to know about whether it's worth investing or looking into electric car companies and companies that make batteries. Or bikes, etc.
Sure. So, okay, so huge disruption coming in the automobile sector. And what's happening even faster than the automobile sector is the electric bus sector. That electric buses are just, you know, displacing so much more fuel and gasoline than electric cars are. So again, I would just be really, really cautious when it comes to electric cars. I mean, I get a lot of people who want to talk about Tesla, and it's like, sure, you can buy shares in Tesla, but then you're like dealing with Elon Musk and his kind of manic personality. And, you know, every time he tweets, it's like, oh, what's going to happen to the stock? So, you know, I would really caution against going into specific technologies or specific companies. There are some ETFs. So there is one, I believe it's PBD. I joke the acronym is Peanut Butter Delivery. And that's the Invesco Global Clean Energy ETF. And that's going to have a lot of exposure. Tesla's in there. There's a Chinese electric car and bus company called BYD, Build Your Dreams. That's in there. It's also got a lot of battery manufacturers. So there's one called Samsung SDI, which is Samsung's battery division. They're all going to be in there. But you're also going to get some other things like there's organic LEDs in there. There's going to be some energy efficiency in there. So you're not sort of going whole hog on that technology. There are things like there's a lithium ETF, but I'm not convinced that lithium batteries are going to be the solution in looking out, you know, 10, 15, 20 years. It's very possible that there could be a disruptive technology. And I always like, there's one company that I always use as a case study. When people ask me about specific technologies, how many people ever heard of Ballard Fuel Systems? Do I have any? Okay. Did anybody invest in Ballard Fuel Systems back in the day? Because if you did, you know what I'm talking about, and you probably lost your shirt. I'm just going to share my screen for a moment so that I can show you this chart. So Ballard Power Systems is a company that was all about hydrogen fuel cell cars. And there was a time where everyone thought that hydrogen fuel cell was the way to go. And you can see their share price, you know, went from like $10 and then it went up to $54 and then back down and back up. And then it shot up all the way up to $165 per share in the early 2000s. It stayed up there with the tech boom. And then when the tech bubble popped, it went from $165. Now it's trading at $4.33. Now, I have no problem with hydrogen fuel cell technology. I think it's a really cool technology. I think that it makes a lot of sense from an environmental perspective. I really like hydrogen fuel cells. But obviously, we're not driving hydrogen cars. And there was a time when people were convinced that hydrogen cars were the future and that that was the way to go, and that's where I should invest my money. And I'm hearing a lot of the same talk right now around electrification and with electric cars and lithium-ion technology, lithium-ion batteries, which for now, those are the cheapest, and that makes the most sense. But when it comes to investing, right? Just because it's logical and it's the smart thing right now doesn't mean that it's going to be the smart thing over the next year, 5 years, 10 years. So I would really caution you against going, you know, putting too much of your portfolio into specific companies and specific technologies. Feel free to carve out, you know, 2 to 5% of your portfolio. That can be your mad money, and like go to town when it comes to those companies and those technologies. But I would much prefer you buy a more diversified ETF that has electric car companies and that has lithium batteries inside of it. That way it's going to be more diversified. If we're right, you know, and you're right, and that's the technology of the future, you're still going to do great. But if a disruptive technology comes along and ends up replacing that, you're not going to lose your shirt.
So thank you for that question. It's great. And thank you very much, Tim. You rock. It's almost midnight there. And we really appreciate it. Thank you so much.
My pleasure. Thank you so much for the opportunity. I really appreciate it.
So you're signing off, and thank you again. And we're
All
going to be here for the next hour still. There's breakout tables. I'll be talking about what's going to happen.